Good afternoon, everyone. You're all very welcome to today's session from the public sector group. For those of you who don't know me, my name is Graham Wilkinson, and I am the chair of the Ulster Society's Public Sector Committee. Some of you may have been at the session back in January, where Robert Kirk provided us with a really interesting and an insightful overview of leasing and the various changes that are required. As a committee, we were really delighted with the feedback that we've received. It was a really interesting session, and Robert, you have a lot to live up to. But we were keen to have Robert back again to present to members on an area that is definitely going to change the way that we produce financial statements going forward in the public sector. I appreciate it's a little way off, but certainly I think it's useful to get some insight on the potential changes that are going to impact many of us working in the public sector. So Robert's going to provide a bit of an overview on IFRS 18, a bit of an insight into the various changes. And similar to last time, we're very keen to get some engagement from members as we go along. So there's a chat facility within the system. So please do feel free to pop in any questions. And as we get to the end of Robert's presentation, I'll try and corral some of the questions that you might have. So I really do hope that you'll find today's session interesting, and we'll get a bit of an engagement in terms of the Q&A with Robert going forward. So I'm going to pass over to yourself, Robert, and hopefully we'll pick up some questions at the very end. Thank you.
Thanks so much, Graham. Good afternoon, everybody, and delighted to be able to present again to members of the public sector here in Northern Ireland. The topic that we're looking at today, as Graham says, is probably 2, maybe 3 years away before it comes in. And also, it's nothing like the changes that were made to leasing, certainly not as dramatic. Now, I have brought in about 85 slides, which there's no way I could cover 85 slides inside an hour. But I wanted to make sure that everybody had a rough idea of the whole length of the standard, from section 1 right through to the last section of the standard. But a good chunk of it has not changed, because this is really a revision of the very first international standard, IS1. And I would say to you that 2/3 of IS1 has now been retained and brought into IFRS 18. So it's really mainly dealing with performance reporting and the changes to the layout and presentation of the cash flow statement. Those are the big changes that are happening. And there are some interesting ones happening more to the private sector in relation to what are called MPMs, which are really the alternative measures of performance that you tend to find being used in the private sector. So without any more ado, let's go ahead and go through it. The reason for it, I'll just skip that one if you don't mind. The standard itself took 5 years. Now, that's a ridiculous amount of time from the exposure draft right through to the publication of it. But don't forget, COVID was in the middle of this, and there were also other issues dealing with insurance contracts and so on that they had to deal with first of all. So, you know, it looks at 5 years, my goodness, they must have had problems in getting this one through, but they didn't really. It was a very straightforward standard amendment. It's coming into the private sector, and by the private sector, I'm only talking really about listed companies here for their consolidated accounts from the 1st of January 2027, and into local accounting in FRS 102. That probably won't happen for another three or 4 years until the next big revision of FRS 102 takes place. The document itself, you'll see from this slide that it's concentrating largely on changing performance measure, the statement of profit and loss. That's where the major changes have taken place. And also to the statement of cash flows, there's some changes being made there, but there's nothing really happening to the other primary statements. The balance sheet of the statement of financial position, the statement presenting comprehensive income, and the statement of change in equity are really remaining the same. Now, the objective is simply, it's all for general purpose financial statements. So it's your annual report we're talking about. So the information you provide faithfully represents your underlying assets and liabilities, equity, income, and expense, the usual stuff there. Scope-wise, well, it's only really for people preparing accounts under IFRS. You will notice in the fourth bullet point that the point's been made that the terminology that's being used is for the private sector. It's suitable for profit-oriented entities. And when the government, through Treasury, produce an amended FReM, they'll have to obviously tailor it more towards the public sector. That's the main point I would drive out of those 5 or 6 paragraphs there. Now, as usual, there's no change in terms of the objective. We're looking backwards and we're looking forwards. So we want to make sure that the directors and managers are made accountable for their actions of the past year, the old stewardship function, but we're also hoping that the information that is being provided will help to assess future prospects as well. So it's going backwards and forwards at the same time. The primary statements haven't changed. There are the 4 main ones there on the slide, backed up by notes, obviously having comparatives of the previous period. And in some cases, particularly with the change in accounting policy, you're supposed to bring in an opening statement of financial position. There's no difference in terms of prominence. Every one of the primary statements should be treated with equal respect. Again, in the private sector, there will be a requirement to have either a single statement of performance or 2 statements. The more popular one is to have 2 statements with a profit and loss and then a statement of comprehensive income as the second one. Now, what they've done here is this is one change. Well, not really a change. It's basically trying to clarify basically what are the roles of the primary statements versus what is the roles of the notes. And it's pretty obvious stuff because the primary statements are providing a useful structured summary of the entity's assets and liabilities, income and expenses, etc., and making sure you get good comparison between the previous year and this year, and also identifying items that might want further information in the notes. And the notes are really the backup to the primary statements, give more information of the information which is already in the primary statements, and also supplementary information, which of course would be things like contingent liabilities, capital commitments, and that type of stuff. So there isn't really any change. They maybe just clarify it a bit better, but there's no real change there in terms of notes. Interestingly, however, in the paragraphs 19 and 20, it does say that you don't need to provide a specific presentation or disclosure that's actually required by the standards if it's not material. So they're bringing materiality in and what you need to disclose, which is interesting. So you can get away without disclosing certain information that is normally required by the standard. But in addition to that, sometimes you have to give more information than is in the disclosure requirements of the standards if you feel it's insufficient to enable users to understand the effect of transactions and other events on your position or performance. No change in how you identify your financial statements. I'll not go through that. You've got to give the name of the company in case you'll be named of the department. Is it group accounts or individual accounts? What's the year end? Currency would probably be obviously sterling, and level of running would be hundreds of thousands or something like that of pounds. Frequency, well, the public sector, of course, is always going to be annually. The private sector has more of an opportunity to change their annual reporting date, and they can do so in some occasions there. So that would be really not particularly relevant to the public sector because of the annual requirement. You must be consistent in how you present, disclose, and classify information unless there's a change in the nature of your business or organization, in which case you may have to follow IAS 8, which is all about prior year adjustments and things like that. That happens also when you make an error. Unique comparative information, that's pretty obvious. Again, I'm not going to go through the detail of that, but it's necessary to have last year's information provided side by side with the current period. Where you do have to change your accounting policy, which does happen occasionally, there was obviously in the leasing one we've just talked about in January. You need to give nature of the reclassification, the amount, and the reason for it. And if you can't do that, you need to give a good reason why you can't do it and the nature of the amounts that would have to be classified. Nothing really happening here either. A third statement of financial positions required at the beginning of the preceding period, in addition to comparative, if in fact you've had to apply your accounting policy retrospectively. And it also has material impact on the information at the start of the year on your statement of financial position. Now, what other changes? Well, they brought in principles for the first time on situations where you need to aggregate maybe a number of similar type expenses together, and in other cases where you have to separate them out and disaggregate them. Now, I don't think it's really changing anything. It's just adding principles to help you decide when to aggregate and when to disaggregate. And we'll see that in a second or two. And there's also a need to have very clear labels in any of the information that you have in your line items within your primary statement, particularly in your performance statement. And there's also, for the first time, a lot more flexibility being introduced in the type of expense that you record in your statement of income and expenditure. So up until now, you had to, certainly in the private sector, you had to choose whether you're going to analyze your expenses by nature or by function. You couldn't mix them, but now you can. You can choose the most appropriate way to present your expenses. Sometimes you will use the nature of expense, and sometimes you will use function. But for those items that you're using functional analysis, there is a requirement now, as we'll see in a minute or two, that you need to disclose 5 items, specified expenses by nature, in addition to function. Now, the principles I've mentioned, it's a bit waffly. It basically says you should aggregate items that share similar characteristics, and you should disaggregate items that have different characteristics. So it's not really saying an awful lot that we didn't know. And you should make sure that whenever you group items, you don't obscure material information or reduce the understandability of the information that you're providing to the readers. And make sure you get the items in the right place. Should they be in the primary statements or should they be in the notes? So there's nothing new in this. It's just maybe setting down the principles maybe for the first time. You're not allowed to net off things. You mustn't net off assets and liabilities or income expenses. That was always been the case, unless it's permitted by another international standard. But be very careful, because sometimes things which look like liabilities aren't liabilities at all. Bad debts, for example, are a reduction in the value of your debtor. So it's a reduction in an asset. A provision for obsolete stock is a reduction in the value of an asset. It ain't a liability. So it's not offsetting. So you just got to be careful there. But the general rule is, for genuine asset liabilities, they should not be offset unless it's permitted by another standard. Now we come to the big changes. Now, the first big change is being introduced to the way that the profit and loss account is being presented. And in the next slide, we'll see that income and expenses within the private sector in IFRS 18 will have to be split into 3 defined categories. Now, something similar is going to happen to the public sector as well. And then there are 2 subtotals, that compulsory subtotals that are going to be required as well. And we'll see those on the left-hand side of the slide. So if we go to the slide itself, let's have a look at the right-hand side. You'll see in red there on the right-hand side that your expenses have to be split, and incomes for that matter, have to be split between operating, investing, and financing. And that should be quite familiar, because that's the way the cash flow statement is currently done. You split your cash flows between operating cash flows, your investing cash flows, and your financing. So in many ways, it's tying in the profit and loss a little bit closer to the cash flow statement. Now, if we just look at the left-hand side, these are the new compulsory headings that you have to bring in. So operating profit is going to be a requirement, and that's supposed to give the reader of the accounts a complete picture of the company's operations. Now, what will happen within the public sector, I don't know. I assume there'll be something similar to that brought in as a compulsory heading. And then there's another compulsory heading, which is profit both before financing and tax. Okay, tax wouldn't be as big an issue in the public sector as the private sector, but financing would be. So you may find there's another subtotal that's going to be required when FRAB looks at this and Treasury looks at this again. The last thing on the slide I'd just like to point out is look at the analysis of expenses. You have functional headings there, cost of goods sold, selling expense, general and admin expenses. Those are functional headings. But you also have research and development expenses, and you also have goodwill impairment losses. Those would be regarded as nature of expense. So there we see a mixture of analyzing expenses by nature and by function, whatever is the most appropriate way to analyze your expenses. Now, flexibility is not something that the public sector likes. So I'd just be interested to see what will happen. Will FRAB and Treasury agree a fixed presentation with no flexibility? My gut feeling is probably they will do that, and they will maybe still retain the existing layout in that regard. So there is comparability from one entity of government to another. Whereas here in the private sector, you're going to have less of comparability because people will be analyzing their expenses in different ways. But the whole idea is to show performance through the eyes of management. It's the way that they perceive the way that the company has been run. That's why they've allowed this increased flexibility. So there are the headings. We've already covered operating, financing, investing. Obviously, tax, and then at the very bottom there is discontinued operations, which doesn't really happen very often within the public sector. Now, operating category, what goes in there? Well, it's basically, from the private sector's point of view, it's going to be the income expenses arising from the company's main business activities. But it's not just that. It includes everything else that doesn't fit in to the two other categories. And that's the same for the cash flow statement as well. So it's your default category. If you can't fit it in to the other two categories, you have to shove it in to operating. In terms of investing, we're talking about things like rental income, remeasurements of investment property, interest income, fair value changes in financial assets, dividends, that type of thing coming in, even income from subsidiaries and associates and so on. They all come in, and income from cash equivalents. So interest income from your, even from your normal bank accounts would go in there. So that's the investing category. And in fact, that's the words that they actually use in paragraph 54 of the standard. So income generated by the assets, income and expenses from initial, subsequent measurement, deed recognition, and increment expenses as well going in there. Now, there are some differences, of course, within the private sector, because you do have entities which are called those with specified main business activities. We're talking mainly about banks and insurance companies and people like that. It doesn't make sense for them to put interest income into investing. It's not right, because that's not their business. Their operating business is to lend money to somebody else or to their customers. And therefore, any interest income that they receive surely should be regarded as their operating income. And that's recognized in the standard. So there are specialist rules there, really, for banks and insurance companies. And there's also specialist rules for, let's say you might be a retailer and you provide financing to your customers. Now, if that's part of your main business and providing that type of business, interest-free credit or something to your customers, that is regarded as an operating income, not regarded as investing income. So they recognize that as well. And that's mentioned there in the very last part of that slide. It's included within financing. If you're providing financing to your customers as your main business activity, that's operating, not financing. So there could be issues there in terms of which category it goes into. Now, not actually in the main part of the standard, but in their base of conclusions, they provide very useful little flow charts. And that's really to guide people into better understanding where things should go between their operating category and the investing category. Now, I'm not going to go through that slide, but I suppose the main thing you'll see there is that investments in associates and unconsolidated subsidiaries would generally be regarded as being investing activities because you're probably using the equity method of accounting. And there's another flow chart basically, which is dealing with the more specialist type of activity where you're providing basically the cash. You're giving interest-free credit or something to your customers, then that would probably go in to your operating category there in the second box in the bottom there. So there's quite a lot of guidance to try and help organizations decide between investing and operating. As regards financing, that would be receipt and return of cash from shares, reduction in financial liability or more extra borrowing. Bank loans go in there. Lease liabilities, interestingly, goes in there. All the interest expense from that, and the defined benefit pension liabilities. Any changes in those, they also go in as a financing category. There is some discussion about some liabilities which do not arise from raising finance. And it does say that you should still classify them as financing if the interest income and expenses are only if identified under other standards as being financing. Otherwise, they would go into operating. So again, this problem in deciding whether it's operating or financing, there's extra 4 or 5 paragraphs there within the document to try and help people decide which side of the fence they actually lie. There's another flow chart again to help people in that particular approach. Again, I'm not going to go through it, let you have a look through it in your own time. I think that's basically the same one, so apologies, that's almost the same slide. Again, this slide is simply repeating what I've said for banks, financial institutions, and people like that. Then their main activity is to raise, to lend money to their customers. So items that would normally, for most organizations, go into investing or financing would end up actually within the operating category. Okay, again, that's just repeating the same thing again, just taking from paragraph 51 and 55 there. Right at the back then, about halfway through this document, they do mention tax, but there's no change there, and there's no change to discontinued operations, which are governed by IFRS 5. So see, it's all this discussions are all about arriving at the operating, investing, and financing parts of the performance statement. So that's probably regarded as being the major change that's happening within IFRS 18. There's also a requirement, as you see there, we've just repeating again, these are compulsory subtotals, which I've already mentioned earlier on. That doesn't prevent you from bringing in additional subtotals if you wish. One example might well be there that some people would regard if they invest in an associate which is in the same line of business as themselves, that really feels more like an operating income rather than being treated as an investing income. So to enable that to happen, you could actually, for example, bring in a further subtotal to include the share of associates under the equity method, if you feel that would be a better way to present and you feel it feels more like operating rather than investing. So there's a bit of flexibility there as well. That's just, again, going through the list of things that should be in line items. But again, of course, that's for the private sector. Treasury will have to decide what layout is going to be ultimately for the public sector. And again, in the private sector, there is a requirement in group accounting to separate out the profit and loss between the people who are the parent owners and the non-controlling interests. You have to allocate the profit at the bottom between the two separate parties because the NCIs are not part of the group. Now, this is the second biggest change, which is covered in 78 to 82, and I've already alluded to it, because it's now given the private sector, anyway, a lot more flexibility on how they should classify and present their expenses. They've got to decide what is the most useful structured summary of the expenses, using either the nature or the function or a mixture of both of them, whatever you feel is the most appropriate one. And that point is mentioned particularly towards the end there. The first part of that slide is just talking about what the nature expense is and what the functional analysis is. But then it goes on to say that you've got to choose whichever line items provide the most useful information, and also what line items most closely represent the way that the company is managed and how the management reports internally. So it's trying to bring the P&L more towards the management accounting type information that it's been in the past. And as it suggests there at the bottom, some companies might decide that classifying some expenses by nature and others by function provides the most useful structured summary. It'll be interesting to see, in the next couple of years, how this pans out. Will companies in the private sector change their current analysis of their expenses in their profit and loss account? Now, the standard then requires those entities that are using any functional analysis at all, they will have to back it up by a further note, a compulsory note, where 5 items: depreciation, amortization, employee benefits, impairment losses, and write-downs of inventories will have to be analyzed by nature. Those are nature expenses. And you'll have to tell the reader whereabouts in the actual statement of profit and loss these items lie. So this will be a compulsory note, a new compulsory note in the financial statements. That is where you're analyzing any of your expenses by function. There's the 5 again. And it doesn't necessarily have to be the figure which is in the profit and loss account. No, because there are situations where perhaps you're using equipment to build another asset, maybe plant equipment to build a building, and therefore you're capitalizing the depreciation of that plant in the value of the building. Well, that wouldn't be in your P&L account, of course, but it would be in your depreciation charts. So you would then have to explain that in the notes, because the amount that you're disclosing does not have to be required to be an expense. They could be capitalized as well. And therefore, there will be a need to have some form of a qualitative explanation if you have put some of it into the carrying amount of assets rather than writing them off within the statement of profit and loss. So again, paragraphs 83, 85 list them. And it also explains, well, what do you mean by these 5? Well, the definition, if you like, of each of the 5 is covered within existing standards. So IAS 16, which deals with normal property, plant, and equipment, IAS 40, which deals with investment property, and IFRS 16, which of course deals with leasing. Where you're depreciating in any of those standards, that's what we're talking about that has to be disclosed. And the amortization charge is the figure that goes in for intangible assets under IAS 38. And for employee benefits, it would be the charge that you're putting through for pensions and for other wages and salaries and so on under IAS 19. And then share-based payment under IFRS 2. And then impairments, they're being governed by the impairment standard, which is IAS 36. And the inventory is per IAS 2, which deals with inventory write-downs. So That's made it very clear what they mean by those 5 items and where you gather them up from, if you like. Here is the example that they provide in the examples to back up the standard. And there you'll see the 5 headings in blue, and then where they are within the actual profit and loss account. So depreciation is included within the functional heading of cost of goods sold, the functional heading of general admin, but also some of it has gone into the nature of expense heading, R&D. And amortization is all gone into a nature of expense. Employee benefits has gone into a mixture again between the nature and function analysis. Impairment has all gone into 2 separate nature ones, and inventory also. So even though the standard specifically mentions that you've got to back up the functional analysis, I think they're really looking at where the total of those 5 items can be seen. Where would you see the total of these within the statement of profit and loss account, and in some cases, the statement of financial position as well? Now, in the examples, and there's a good set of examples, a separate booklet dealing with that, they gave a very good example of the layout and presentation of the statement of profit and loss. And this example is a group, and the main part of it is the second paragraph, where the group concluded that the most useful structure summary of its expenses is providing by presenting in the operating category of the statement of profit and loss some expenses classified by function and other expenses classified by nature. But then they go on to explain. Now, it doesn't specifically say that you have to do this, but I think it is probably a good idea to explain why you chose this particular analysis. And they've explained that by saying that presenting expenses by function most closely represents the way that the business is managed and how the management reports internally, and the standard practice within the industry in which XYZ Group operates. However, XYZ Group presents goodwill impairment loss separately because any allocation to function line items would be arbitrary and would therefore not provide a faithful representation of the functions. And they've also concluded that presenting the additional subtotals, gross profit, profit before income tax, and profit from continuing operations provides a useful structured summary of its income and expenses. So a very good narrative analysis explaining the overall approach. And then what the example does, and then gives you this particular statement of profit and loss, which is actually very similar to the previous one I've just shown you. Except I think at the bottom you will see the loss from discontinued operations right at the foot, and you'll also see the split up between the owners and the non-controlling interests, which you have obviously in group reporting. And then the need in the private sector to disclose earnings per share figures down at the bottom. But you'll see in terms of subheadings, they've got gross profit in bold there, operating profit, profit before financing and income taxes, and then profit before income taxes, and then profit from continuing operations. So you can see quite a number of major subheadings, some of which there are compulsory, particularly the 2 in the middle there. This is another example, but this time we're dealing with a company which basically, whose main business is manufacturing, but it also provides financing to its customers. So it gives us interest-free credit or something like that, or low interest or something in those lines. So they've concluded in part B there that presenting in the operating category of the statement of profit and loss some expenses classified by function and other expenses by nature, again, is the most useful structured summary. But then over and above that, they've gone on to say in the financing category, income and expenses arising from liabilities that arise from transactions that involve only the raising of finance that do not relate to the provision of financing to customers. And in the investing category, income and expenses from cash and cash equivalent that do not relate to the provision of financing to customers. So again, they're separating those out into operating. And again, we'll see that in the example statement of profit and loss there. You'll see that right at the top there, after the gross profit from the sale of goods, they brought in interest revenue relating to providing financing to customers and interest expenses relating to providing financing to customers, giving you a net interest income. So there's a new extra heading going in there, which seems sensible. So you've got your main operating income from the sale of goods, and then you've got this other interesting form of operating income coming in from providing finance to customers. And then you have the other compulsory headings there of operating profit and profit before financing and income tax. So those are some examples of the layout and presentation of the statement of profit and loss. As I said to you, I just don't know what FRAB and Treasury will do. And my gut feeling is that they'll probably try to limit the changes. And I just don't know what extra subheadings they could possibly bring in. So I can see this very much as being something which is very much almost totally private orientated rather than public sector orientated changes. That's just another example, but it's virtually the same as the previous one I showed you, the compulsory note. A compulsory note where you have unfortunately decided some of your expenses should be by function. Once you've done that, then you need this extra note to specify 5 items by nature. Now, there's nothing happening to the statement of comprehensive income. So normally in the private sector, we have 2 documents, a profit and loss account and a statement of comprehensive income. But as I said earlier on, you can add the 2 together. But there's nothing happening. There's no changes from the original IS1 required here at all. So I don't think we need to worry too much about that. Just to remind you, within the private sector, there's also a requirement to split other comprehensive income into 2 separate types. The first one is bringing in income expenses that are reclassified to profit and loss when conditions are met. I don't like the word reclassified. I would prefer to use the word recycled, because what happens is the gain or loss initially goes into other comprehensive income, and then once it's realized, then it also goes into the profit and loss account. And we're talking about hedging gains and losses, which initially go into cash flow hedging, goes into reserves and goes into the statement of comprehensive income. And then when they're realized, when the hedging comes to an end, then they're recycled back into the profit and loss account. Foreign currency differences is another example. Initially go into reserves, initially go into other comprehensive income, and then get recycled back into profit and loss when they're realized. But what happens to other items, for example, the revaluation of property, the revaluation of property never, ever gets reclassified back into profit and loss account. So that means when you're selling a property, you take the difference between the proceeds and the revalued book figure. That's the item that goes through your income statement or your profit and loss account. And basically the revaluation reserve, although it's realized, effectively goes straight into reserves. So it's a transfer within reserves. It certainly doesn't get recycled through the profit and loss account. So that's why the document always requires you to split your other comprehensive into those 2 categories, those which will be reclassified and those which will never be reclassified. And then there's also a need to separate out the share of any other comprehensive income of associates and joint ventures using the equity method from other items of other comprehensive income. This is the example that they provide, and there you'll see in bold income expenses that will not be reclassified to profit and loss. So there's your defined benefit plan, remeasurements of those, um, and the ones which are reclassified in this case are exchange differences on translation of foreign operations and losses on cash flow hedges, which I've already mentioned. So that's the two subheadings that you have to have in your comprehensive income. But that's no change. There's no change there from what was in the original IS1. What about the statement of financial position? Well, there's nothing happening there. It's covered in 96 to 98. Obviously, the key message is to make sure that you correctly analyze your assets and liabilities between those which are genuinely current and those which are non-current. And that's the main message that has to be mentioned there. And in particular, deferred tax has to be treated as a non-current item. Again, there's no change to the definition of what a current asset is. It's mainly items that will turn into cash within 12 months, but it could also be like whiskey or something like that, which takes many years before it actually sold off, time it matures and sold off to the customer. So that would be a normal operating cycle. So that would still be regarded as a current asset, even though it's not going to be realized in the next 12 months. But again, no change happening there really to the statement of financial position in terms of analysis, in terms of definition of current assets, nor for that matter, current liabilities. Again, the layout of the statement of financial position hasn't changed. The only thing that they've brought in is that they've now brought in the insurance contract standard IFRS 17. So you'll see portfolios of contracts under IFRS 17 in F there, and under the asset side, and then P on the right-hand side there, portfolios of contracts under IFRS 17 that are liabilities. But there's nothing really happening there in terms of the items that should go into the statement of financial position. Again, you have to split up the amount of the net assets that belong to the, or they should really say the capital reserves that belong to the non-controlling interests and those that belong to the parent owners. There's guidance within the base of conclusions, that's paragraphs B109 to 111, and how you should use your own judgment in determining whether the items should actually go on the face of the statement of financial position or should be merely in the notes. Now, there's no prescribed order or format, but again, that's not necessarily going to be the case for the public sector. I think that will be determined very largely as a fixed format. I would imagine whenever this is re-looked at by Treasury. There's the layout in the example. Total current assets there and current liabilities, or sorry, current assets. So giving a total assets, which wouldn't be the more popular method. Most people deduct their current liabilities from their current assets to get net current assets, and add that down to the non-current assets, leaving the second half of the balance sheet to be really, to be honest, your non-current liabilities and your equity. So no real change there in terms of what goes into the statement of financial position. Also, no change really going into the statement of change in equity. I'm not worried about going into that in detail, but nothing is really happening in those 5 or 6 paragraphs that are now covered there. They do provide you in the examples of a statement of change in equity, and as I would expect, the document is very unwieldy, certainly for very large group companies. It's almost impossible to get them onto the vertical plane, so you have to turn your page sideways to see them, because there's so many items between the left-hand side to the right-hand side, it just doesn't fit onto the page properly. You'll see lots of headings there. There's the foreign translation reserve, there's retained earnings, there's defined benefit, reserves there. You've got associates, you've cash flow hedging, and then you must bring in your non-controlling interest on the right-hand side there. Now that has to be done, of course, for 2 years running, and the 2 years that they're provided. Also notice that prior year adjustments, which are mainly changed accounting policy, are adjusted to the opening balances there. Now, in terms of the notes are covered between paragraphs 113 to 116 of the standard. Again, what is disclosed is not changing. Base of preparation, backing up the information in the primary statements, and then other information like contingent liabilities, capital commitments, and so on. It should be presented systematically and cross-referenced. So I think what that really means is if you start with your P&L first, then your P&L notes come first, and then balance sheet notes second, cash flow notes third, kind of thing. And then there's some legalistic type of information that's also required, and that hasn't changed. That's always been required. Now we move on to the next big change, and that is the introduction of a new definition, something called an MPM, a management defined performance measure. Now, you're probably aware that within the listed companies in particular, the management team realize that the vast majority of investors haven't got the time to go around through the detail of the financial statements. So they tend to provide loads of ratios and alternative measure performance in their communications with investors. Now, there's no doubt about it that investors find those measures very useful because it shows or gives them an insight into how the management team views the company's performance. But the quality of them is poor. Often they don't provide a clear explanation of how they've been calculated. No rationale as to why did you choose these particular ratios or measures. They're not tied back to the official figures required by the IFRS standards, and there's very little impact or explanation of their impact on tax or non-controlling interest. So they're saying, look, we think they're a good thing, but we need to tidy it up. And so what they've done is they've introduced a definition, a formal definition of what they now call MPMs. Generally up to now, they've been called APMs, alternative performance of measure. But this is now the official term MPM, management defined performance measures. Now they're defined as subtotals of income and expenses. That's quite important. There has to be a subtotal of income and expenses, other than those listed by IFRS 18 or specifically required by other standards. That the company, they must use them in public communications outside the financial statements, and they're using them to communicate to investors management's view of an aspect of the financial performance of the company as a whole. So this is all about tidying up the whole process. Now, it's going to be a problem to decide what exactly is an MPM, because if it's already specified by a standard such as IS3, that's not an MPM. Earnings per share, for example, would not be an MPM, nor would things that are not a subtotal of income expenses. So things like free cash flow, net debt, all those would not be included. It has to be a net figure, a subtotal of income expenses. So a few of them are mentioned there on the left-hand side: adjusted profit, adjusted operating profit, and so on. There's quite a few items which are deliberately excluded in paragraph 118, as you can see there, even though they are net items. And they know there's going to be some interesting views as to what is an MPM and what's not. So once again, they've introduced a flow chart to help people. This is not in the body of the standard again, this is in the basic conclusions. So they're trying to help you decide what exactly is an MPM. Now, I won't have time to go through all of that. And again, from the public sector's point of view, it's probably not a big issue because I can't see that as being something that FReM would be keen on advising Treasury to bring in. The objective, anyway, of these measures is to show an aspect of financial performance through the eyes of management. And it's important that people understand how it compares with the official measures. So that should all be in a single note. So there should be a single note which is called MPMs. And each MPM should be clearly labeled and described in an understandable manner. What disclosures are required? Well, there need to be a reconciliation back to the official figures in IFRS 18 or maybe IS3. You need to have a description of them and how you believe they communicate management's view. Have you changed any during the course of the year? How did you calculate it? And basically a statement that the measure does reflect management's view of the financial performance of the company as a whole and is not similar to any other company. It's unique to this particular entity. They give you an example of that, again, in the examples, and there's the official figures, the IFRS figure there, which is the operating profit or adjusted operating profit, and there's 3 adjustments to that to arrive at the MPM there. But again, notice it is a net figure, and there's a narrative explanation for the 3 adjustments down at the bottom there of those. And you need that not just for the current year, but for the previous year as well. Now, we're almost towards the end. There are a number of paragraphs dealing with capital, paragraphs 126 to 129. But to be quite honest, these haven't changed. There is a need to have information that enables users to evaluate the overall objectives and policies and process for managing capital, and that should be both qualitative in terms of the information provided and also should be quantitative as well. And if you've made any changes in the course of the last 12 months, then you need to explain that. And are you complying with any external imposed capital requirements? So again, I think this is very, very much private oriented. I can't see this as being a particular issue for the public sector. They do provide you with an example of how you would apply that paragraph by a particular, just a normal group that's not a financial institution and is not subject to externally imposed capital requirements. So they go on to explain the objectives there, safeguard the ability to continue as a going concern, provide adequate return to shareholders, commensurate with the risk that is attached, and basically explaining that they set the amount of a capital in proportion to the risk, and they manage their capital structure and change according to changes in the economic conditions and risk characteristics of the underlying assets. So a good narrative explanation there, qualitative explanation. And they monitor it on a basis of debt to adjusted capital ratio, explain how that's arrived at. So that's no change from the previous years. You can see that they're covering all the requirements there that I showed you in a previous slide, and even talking about the maintenance of a debt to adjusted capital ratio of the lower end of the range, 6:1 to 7.1. And there's the quantitative information as well provided to back it up. And then we move to the last couple of disclosures. There's a need to disclose backup of the share capital in terms of each class and to give an explanation for each reserve and the purpose of each reserve that's in the financial statements. Again, there's no change in that. That's all been there in the past. So to finish off, this is one that definitely will affect the public sector because we're now tidying up the cash flow statement. There are 2 major changes here. The first major change is those entities that are providing the cash flow through the indirect method, which is used by 99% of companies in the UK. 99%, and in the public sector it's the same. So you start with an income figure or a profit figure, and then you reconcile from the profit figure to the cash flows from operating activities. Now, the starting point up to now has been all over the place. So some people were starting with gross profit, some adjusted profit, some operating profit. There wasn't any normal thing. our normal starting point. It was all over the place. So now we're going to have this compulsory subheading for operating profit or loss. That's the place to start for everybody. Will have to start and do their adjustments, their non-cash adjustments there to arrive at cash flow from activities. That'll lead to greater comparability from one entity to another. The other big change that they're bringing in is that up until now, interest received, interest paid, dividends received, and dividends paid could go everywhere, anywhere within the three major subheadings in the cash flow statement. Again, that leads to a lack of comparability. So they've now decided that interest received will go into investing, clearly into investing. Interest paid will go into financing. Dividends received goes into investing, and dividends paid into financing. However, once again, for banks and financial institutions is a little bit different because it doesn't make sense to put their interest received into investing when it's their main business activity. So they're going to bring it in probably into operating because that's what makes sense. And again, possibly one could argue that any interest income for those example I showed you of the manufacturer who is also offering interest-free credit or low interest to their customers, offering finance to customers, that would, if that's their main business activity as well, that would have to be classified as operating cash flow in addition. So please remember that's a change, it's not to do with IFRS 18, it's a consequence of IFRS 18, and that's an amendment to the cash flow statement, IS7. So I do see that one as definitely having an impact on the public sector in terms of tying things up a bit clearer. So that kind of brings us to the end of it. There are some very minor changes going on there to the earnings per share standard and to interim reporting. Particularly the NPMs will have to be brought into the interim statement as well as the annual report. But nothing really happening of any major importance there to earnings per share. So to summarize it, what I'm saying, what is happening now is that the old standard IS1 is being withdrawn. A good chunk of it, possibly as much as 70%, is being brought into the new standard IFRS 18. And then the major changes that are being brought in are really to performance measurement, the statement of profit and loss layout and presentation, the introduction of NPMs. Those would be and changes to the notes backing onto the profit and loss. Those would be the major changes that are being introduced, but nothing happening to the other primary statements as such, and nothing to the basic objectives of financial reporting either. So that really brings us to a close. I'd be delighted now to hear if any questions you might want to raise in the last few minutes.
Thanks, Robert. That was really, really good. Thanks for the presentation. Peter Cullen has asked a question in the chat. So you mentioned that materiality override within the IFRS 18 may reduce the disclosures, even if other standards prescribe disclosure. Does the same principle apply to an immaterial item where the Companies Act requires disclosure of it? Peter always asks really hard questions.
Does it override the law? That's really what you're saying. Probably not. From an international perspective, it would, but from a UK perspective, probably not. If the Companies Act says it, you've got to do it. Yes. So in that sense, maybe it overrides it. Yeah.
Yeah. No, thank you. I suppose it was interesting going through your presentation, and if anybody's any other questions, pop them into the chat there. It was interesting. You talked about flexibilities and you talked about FReM. It seems to me that there's lots of decisions required into how this is going to be implemented in the public sector. Even have you any insights, even in terms of timescales or the sorts of engagements that there are with FReM and Treasury? And I suppose as well, what should we be doing in the public sector to prepare for these sorts of changes? I was interested in a lot of the disclosures, I think from a systems point of view that changes will need to be made to capture even some of that information, the way it's being presented in a slightly different way?
Yeah. Well, first of all, FReM, I've looked at their minutes. I haven't seen anything of note yet on IFRS 18. So maybe they're going to be looking at that at their June meeting and maybe November, because they meet 3 times a year. Will it come into the public sector? Probably not until at least 2027, 28. So there's plenty of time. I don't see this as going to cause them too many difficulties. So it's not going to spend months and months of discussion. They don't need an application guidance statement or anything like that as they would for the leasing. So I think the main problem is going to be the layout of the statement of income and expenditure. That's going to be the big change. And I just don't know what their thoughts would be. Will they change it? Will they say, do we need to change it? Because it's all about bringing in operating profit figures and profit before financing. Is that something that's really required for the public sector? Probably not. So I think it's going to be very minor, to be honest, very minor changes. But in terms of getting yourselves ready for it, no, there's no point. Because you wouldn't have a clue at this stage what's going to happen yet. So I wouldn't be worried too much about it at this stage. Just being aware of it. It's going to come. It's going to be the next standard. It's got to have to come into the FReM.
Yeah, no, thank you for that, Robert. Very, very good. We don't have any other questions in the chat, and your presentation must have answered all the queries as we've gone through. So thank you for that. The folks on the call, thank you for your time today. I've certainly found the presentation very interesting. One of the things that we would ask is, following these presentations, we get feedback from members. So please do provide us with your feedback in terms of what works, what doesn't work, and what you would like to see in the future. It's really important for us to try and shape our future programs and making sure that we're meeting the needs of members. The other thing that I just wanted to mention was the CPD Blitz that we're planning to hold on the 18th of June. So it'll be in the morning of the 18th of June. We're hoping to have it over in Windsor Park. So please hold that in your diaries. That would be really, really good. Hopefully we'll get something out very, very soon to you. As always, this session was recorded and we're going to publish it on the Institute's website. So again, this will be accessible to everybody and you'll be able to go through Robert's presentation at your leisure and maybe sort of go through some of the points that we've covered. So again, thank you, Robert, for your time. It has been really, really good. And thank you for everybody who has attended today. So thank you very much.